Good afternoon. Welcome to Chicago Future of Finance. I'm Oliver Rennick. S&P 500 about 20 points off of all-time highs. Pretty solid little grind here today as VIX drops. We're below 16 in volatility right now. We've got Master, MicroStrategy down, Bitcoin down, but that's okay. Rest of the market's firming up. We saw yesterday more weakness in chips, but they firmed up into the close. NVIDIA firmed up into the close. We had a nice finish yesterday to the session. It looks like we're extending that here. Semiconductors up about 1%. We got a really great show coming up. This is going to be a really fun one. We're going to talk with the intraday guys, the traders, Scott Bauer and Brent SpotGamma, as well as Jared Dillian about the numbers from today, thinking about tomorrow before a big jobs report. Good luck making sense out of the numbers today. It was kind of a mess. The challenger cuts looked a little bit high, but then some of the other numbers looked pretty decent. Some of the activity in the economy seems to be pretty solid. ISMs and PMI is still above 50 and looking pretty good there. We're going to get some real interesting Chicago insight from an under-the-radar bank that you might not have heard of, especially if you're not in Chicago. But they're a bank to the banks around this part of town. Performance Trust CEO Chirag Shah joins me, and they have a very fascinating business we're going to get the details on. And we're going to talk with a $400 million RIA that's been slinging options for Midwest clients to balance out some of our conversations with the massive RIAs like Hightower and Crescent. We'll be talking with Seth Hickel from Mindset Wealth about how to find an edge as an up-and-comer in that industry. Let's go to Brent SpotGamma. Let's get into the action. Let's talk the market. The big thing that we've been talking about was that kind of call wall, the gamma wall at 6,400 holding a Brent, and the upside calls generally being cheap. So if anyone was listening to that message, well received if they bought upside, because this is looking like a pretty good little bounce we're shaping up for today.
Yeah, as much hand-wringing is going on over tomorrow's NFP, and you can see in implied vols that traders are a little bit worried about that. We're at all-time high in the S&P. NVIDIA is not participating in that. We got a big lift out of Google, obviously. But you and I were just chatting. Small caps are sneaky here. They're coming up. Big day in home builders, big day in retail, XRT. So there are some other things that are kind of taking the baton and running with this thing at the moment. The big thing when I look at the volatility landscape is nobody cares, right? Think what you want about NFP tomorrow. Next week's implied vols are a 10.
Wow. So it even drops off. So they're not worried about jobs, really.
No, and that's the funny thing here. You see all this stuff on X about global bond yields and every other thing under the sun, but the options market just is not concerned about any of it. Now, if you get a tail print out of NFP tomorrow, then okay, maybe that changes the paradigm. But for right now, it's hard to argue against the bull case because we're at all-time highs and vols are just coming down. And it's hard not to justify too, because 1 month realized vol, which is the barometer for what we've been doing, is at a 9. Which is quite low. But if you're comparing that to a 15 VIX, which is where we are right now, the VIX is actually a little bit rich. So there's some room for that to contract and to come down. And so as kind of strange as it feels a little bit, this is like the most hated all-time high, maybe like ever, it feels like. There's enough squeeze to make this thing pop after NFP because we would contract that vol, and that pushes us right into this really critical third week of September.
The part of it that's kind of interesting is that some of the really frothy stuff has cooled off and remains a little bit cool from some of the recent highs and the stuff that was really explosive. Some of it's coming back, though. Look at Open Door up 14.5% today. Hood's in there with a 3% bounce, too, after it pulled back for a couple weeks. But to your point about thinking about tomorrow and the general volatility landscape looking cheap, let's go straight into my AI question today. It's in your block today, Brent, because what we proposed is tomorrow, should the market be thinking about it as like a win-win? And I wondered if we are kind of back in that scenario where if you get the decent jobs number, it's like, okay, economy feels pretty good, jobs are in place. And then if it's weak, then okay, we just lock in the cuts and those odds go from like 85 to 100%, so I wonder if maybe that has something to do with it. I asked the AI if tomorrow's jobs report comes in strong, then what happens? Does it risk reigniting inflation, stagflation fears? It's one of those questions that comes around like on like a 6-month cycle, basically since COVID. The AI said the headline payroll number is the decoy. What matters is in the mix, strong payrolls with soft wages. That's a growth story. Strong payrolls with hot wages. Then you start talking about stagflation. Also to watch the revisions again, I feel like we have this on like this cycle of 6 months where we never end up having to worry about stagflation too much. So maybe that's why vols are subdued.
Yeah, and I think this is kind of the point. It's like, what is even a bad number and what is even a good number? I mean, if people have jobs, that's bad, I guess. If people don't have jobs, that's good. I mean, so it's like it's
Yeah,
sort of
I
this
think
perverse.
it's kind of like good, maybe.
It's almost like a symptom of boredom a little bit. I mean, again, if we get some kind of a tail print, huge revisions, and all that, then maybe you get into the areas that yeah, I was talking about. But ultimately, at the end of the day, the market's pricing in 100% chance of a cut in September at this point. And so for the next 2 weeks at least, it's kind of like we all know what's going on. And I think that ultimately what's going to happen is it's a nothing done tomorrow, and we just sort of like squeeze vol that creates a rally. And then I think September FOMC is this moment where tons of positions in the options markets are going to change. We're going to have VIX expiration the same day as FOMC. Then you have a huge options expiration. So there's a lot of positions that shift. So from my view, that is this moment where if you want this thing to top out, that starts to be a really interesting area when you get the rate cut, but then you also get forward guidance from Powell, which could be quite interesting. But, at the moment, it's like the bear case is just really losing steam, because I would also add on Tuesday, the Bears had their shot, and what happened? They totally whiffed, right? No fall through.
Yeah. Yeah.
And on that point, it takes us this other. I'm sorry.
They bought gold. They bought gold. That was it. The only marginally bearish thing that's happened is the weakness in coins in Master, and then buying a gold. But I don't think, as I said yesterday, I don't think gold is like going up necessarily a bearish thing. I think just sometimes that's where people like to take their risk is gold.
Yeah, and I was listening to a really interesting macro guy, Warren Paz, said, look, this is about debasement. And something like it clicked in my head. I was like, yes, this is what this is. And I know Jared's who coming on after me is focusing on that gold story too. So, there's a lot of interesting stuff in that realm. And on that point, what we saw on our flow patrol report, which shows daily changes in options positions, we saw some hedges start to come in gold. There were some GDX put buyers, some GDX call sellers, as well as some GLD call sellers. So gold is up 5% in like 4 days. And so that shows some signs of just some short-term overbought conditions. And so that seems like it may be right for a little bit of a pause. And on that point,
I see it kind of shifted a little bit left here on the quadrants in your scanners. So
That's
it was
exactly
that
right.
GLD was further to the right. It was over here the last couple of days.
Exactly. And that is what that is call buying cooling off in favor of put buying. And so that is an interesting thing at an all-time high, right? To see that start to transition, not an all-time high necessarily, but just an interim high, I should say. And so, that to me is this signal that, hey, look, people are indeed selling some calls. They're taking some profit off the table. I'm not trying to stand here calling some all-time high, the top is done for gold. Just look, a little bit overdone, right? Needs to cool off a little bit is my read there. And then the other thing to focus on here as well is calls remain cheap in all sorts of different stuff, right? And so even if you don't want to buy upside because you just think this story is done and NFP is going to be a disaster and the market crashes
calls are cheap
tomorrow,
over here in the lower left, right?
That's exactly right. You can buy Google calls for cheap. That stock just broke out. You can buy tech calls for cheap. You could pick all sorts of things to find very reasonably priced upside into September. And to me, it's like you should just do it as a hedge, even if you don't agree with the upside narrative, right? And so, I think that's an important thing for investors here. You may hate the idea of a rally, but it's very cheap to cap off that risk if you don't really want to play it in any kind of a material way.
Interesting. Okay. I noticed it looks like Q's and SPY are kind of shifting a little bit over here to the further on the right side. Am I reading that right?
Yeah, I think that's actually just a short. I'm questioning those data points, to be honest with you. I think if you actually refresh your browser, we may see those slide a little bit to the right. But a small data issue earlier that was corrected. So the Qs and the spiders should both be on the left by XRT, XHB. So those are
right. That's what we were
those are actually
before.
quite cheap. And I think you just refresh the screen to see that. But the other thing I wanted to touch on here was the proliferation of zero DTE options. Yesterday we saw about 60 to 80,000 worth of zero DTE calls bought in the last 20 minutes of the day. And that led to this just bananas rally at the end of that day yesterday. And then on Tuesday, it was the same thing. There was just wicked zero DT dip buying at 63.50 that brought the market all the way back. My data shows that yesterday we traded 69% of the S&P was zero DT options. I believe that is an all-time high.
Wow.
And that is the third day of over 60% in the last month. And then the data on the NASDAQ is the same. The NDX is trading something like 80% is 0DT options. So there is this dynamic of not only the 0DT condor, which you can see on your screen right there, that's coming in every day and suppressing vol, but the 0DT intraday flows are just massive. And all of those flows are supportive to the market. They're buying the dip, they're suppressing volatility. Now, the problem is they're here today and possibly gone tomorrow, but lately they've been here for today. And those flows are really hard to fight, right? They just keep buying this market back up. And it's a dynamic that is, you just can't ignore it, right? You're talking 69% of SPX volume as 0DTE. It's really rather just stunning. So on your screen there, you see we're attracted
I'm
up to that
tracing it
60.
through the day. I mean, it's just straight. Here it is, basically sent, up and to the right, where it's like anytime there's a little bit of downside, it's like this steady drip.
Yeah, and it's a rolling. The 64.75 gets tagged, and they roll it up to 64.95. I mean, that's a massive amount of gamma sitting there that becomes the attractor for the market at higher prices. And so it's like some of this is just mechanical flow of the market just drifting higher because of these hedging flows at a time when, at the moment, no one else cares what's going on today because people are focused on NFP. So nothing else is really in the driver's seat. Now, tomorrow, we'll hit the NFP early in the morning. And there's not really any material resistance, I would say, up until maybe like 65.50 in the S&P. I'm looking specifically at 654, and the spider seems to be where kind of spider call selling increases. So that's right where your cursor is there to that upside. And then I think, we probably get pretty sticky and quiet over the next 2 weeks, I would think, into September options expiration. But plenty of room for small caps to run higher. Plenty of stuff to chase in this market. I've been half joking about American Eagle, for example. That's up 35% today. Macy's was up 20%. So there's clearly some risk appetite out there in select assets and select stocks.
Is still working for American Eagle? That's crazy. Brent, yesterday we talked about, and as we're looking at here on the where the gamma exposure is, that support at 6,400 was likely to hold, but if we broke, it would be your sign to start getting short. Now I think it's time maybe we start thinking about the flip side, which is when does the steady grind potentially turn into a real rip? What do we need to get through here to where maybe market makers kind of got to chase a little bit, or whomever that's putting this kind of wall on around, what is it, the 64.50-ish? If we get through that, where does that kind of, if you're going for a short-term rip?
Yeah. The big number is 65.05, and that level increases in importance as we get closer to the end of September, and that's because of the JP Morgan collar trade and its position at 65.05. It's not a huge position at the moment because we're still about a month from expiration, but if we can get close up above that level, the closer we get to the end of September, the more that becomes a stabilizer at that price, at that level. And that allows us to sort of use that as a base to spring to the next level up, right? So there's a ton of positions up at 6,600 at the moment. And I think that is kind of, if I was going to circle kind of my best case scenario for September OPEX, I would be looking at that 6,600 number as something that could happen with relative quickness.
Hey, that's pretty nice. That's pretty nice. I don't think anybody's going to be upset with that.
Yeah, that's a 1 to 2% move in the S&P. Now, over that time, what's likely to happen is you're likely to see the VIX really would contract, implied vol would contract, and we kind of, I think, get this grind. We were talking about it as the zombie market last week, right? And I think that S&P, the flows would really kind of ratchet it down. And so I would want to look at small caps, select single stocks, et cetera, as a way to play upside, because I think those could outperform in that type of a market. But, right now, S&P implied vols are saying there is no worry here, and as long as we're kind of up over that 6,400 level, it's hard to argue with them.
All right, so we might be establishing new support at higher levels. Scan the code to get the flow report. It's great stuff. Great analysis this week. Brent, you told us right where the support was supposed to be. It showed up, held it. We knew we were ready in case it broke, and it didn't. So we continued to... It's a good zombie walk. The only problem with the zombie description is, zombies are kind of scary. It's kind of negative. It's like, we got to figure out. It's the snail. It's the snail, rally. Snail rally. Good stuff. Thanks, Brent.
Don't hate on zombies, Oliver.
Right. Yeah, I guess. Appreciate it, Brent. Coach Chuba, SpotGamma. Let's continue to do a little prep for tomorrow, and let's go to the gamble. Jerry Dillian is standing by. Mr. Dillian, good afternoon, sir. We were talking the intraday in this steady kind of snail grind higher. What do you see as the chance for jobs to mess us up tomorrow, to throw a wrench into the bullish momentum we got here?
Well, a bunch of things have happened since the last jobs report. I mean, Trump fired the head of the BLS.
That's right. Yeah,
And
I forgot
so,
about that.
so right. EJ Antoni, her replacement, I don't think he's in charge of the BLS anymore. I guess what a lot of people are not considering is that there's going to be some monkeying with the statistics, and the jobs report could come in much stronger than people anticipate. So right now we're expecting 75,000 jobs on non-farm payrolls, which is easy to beat under normal circumstances. And I, do you really think Trump wants a payrolls number that is less than 75,000? Like, I don't know what kind of machinations have been going on at the BLS.
Yeah, nobody can.
I think there's a risk for a much stronger jobs report tomorrow.
Interesting. I'm pulling up some of the Kalshi numbers, the stats, looking at it right now, and they break it down for above 100,000, above 75, and above 50. What's interesting is the Kalshi disagrees a little bit. They're putting a 29. I guess. Look, I don't know. Here's what I would ask you: here's the kind of point of the segment: is their odds for above 100,000 are 29%. Their odds for above 75,000 are 50%. So would you rather take the coin flip at above 75, or do you think the 30% is low for above 100?
I think it's pretty low, actually. That looks like a pretty tasty trade to me. I mean, I've never been on Kalshi. I've never been on bet on event markets or anything like that. But I would take above 100,000. I would.
Yeah, at 30 cents. Yeah, I guess 31 right now. But yeah, that's an interesting thought. I had not thought at all about the political machinations of this potentially having a blowout number. What's interesting is that there seems to be a pretty strong bet on the other end. I guess the low side is that the higher probabilities that you're just going to be above 50. So I guess to your point too, that kind of is a similar way to look at it. Just we're not going to be below 50. Like they're not going to let that happen.
Yeah, and the other thing is that ADP came in today. It was 52 or 54. I can't remember which, but ADP takes on additional significance now that the BLS data could potentially be corrupted. So, I was actually a little bit surprised we didn't get more of a reaction from the weak ADP number today.
Yeah, and challenger job cuts too were pretty high. That was a real big number for August.
Yeah, so bonds have rallied quite a bit in the last 2 days. So maybe they were a little overbought, but like I said, I was a little surprised we didn't get more of a reaction.
Yeah, dollars firmed up a little bit, but to your point, bonds have too, and the dollar is still at 98. I was kind of watching this the last few months as maybe a scenario where if the Fed cuts and they don't have to, if they're just politically pressured to do it, then maybe that makes yields go up and dollar go up. But I'll tell you what, it's just hard to get a bond sell-off going right now. It seems like there are buyers of bonds at every turn, and we just keep getting stuck in the same range.
Well, I don't have a position in bonds here. I don't really have a strong opinion, but the one thing I always fall back on is if you ask the random market participant if they thought yields were going higher or lower, I bet 80% of them would say higher.
Right.
I think there's sort of this whisper or silent consensus that we have debt problems, we have issuance problems, yields are going to go higher because of supply. And I think the bond market could surprise people, and it has in the last week.
I'm looking at unemployment now. If we kind of take another angle on this, where the Kalshi says 95% it's going to be above 4.1. The forecast right now 4.3. Do you think that as an equivalent chance of kind of getting juiced or lowered, or do you feel that maybe is a little bit of a harder number to mess with?
I think it's a harder number to mess with, but even still, 9 cents for below 4.1. Like, I tend to be an option buyer, not an option seller. I would waste some money on some premium there and bet on lower unemployment.
Okay. All right, I like that. So maybe, I mean, look, if the numbers are real, then it's somewhat encouraging. If what you're saying comes true and the numbers generally surprise and unemployment looks low, do you think we start fading bonds then? Would you be interested in getting into a bond position? What does it take for you to see on the chart to say, all right, there's some momentum directionally here for treasuries?
I'm going to tell you the charts. I mean, I'm a chart guy. All the rates charts are a mess. There's no trend. There's no direction. There's no extreme positioning. I have a tough time taking a position either way.
Yeah. Well, I think I'm with you on that, to be honest, which is that the bond market just hasn't given us clues. I'm watching the dollar to see if it firms up a little bit. But I think, to your point, tomorrow could have a little political angle that people haven't baked in for it. And I like the idea of taking the 31 cents on 100K for a little gamble. Thanks, Jared.
Yep, of course. See you later.
You're the man. Good stuff. We're going to take a short break. We're going to come back, switch some gears, and talk about banking. The bank to the banks here in Chicago. Be right back. There are two things about Chicago finance you can't get anywhere else. The first is kind of hard to miss. Everyone's trading options. SIBO is on a 5-year growth streak making billions, and its goddess of grain sits atop the final pit of open outcry. And that's what it's all about. The chance to fend for yourself. A fortress for the self-made trader, and the only still standing in America. The second thing you may not know, but it's worth trillions. Chicago is the only major city in America that's home to 2 of the top 10 registered investment advisors, according to Barron's. That means a steady river of passive money and fixed income pouring into the city. If you think you can beat the market, this is where you do it. If you've got value, price will discover you here in Chicago, the future of finance. Join me, Oliver Rennick, from SIBO, Tuesday, Wednesday, Thursday, into the closing bell, live from Chicago. Welcome back to Chicago Future of Finance. A big part of the show is bringing attention to institutions that you may not know about. And I feel that one, it's a great symbol of that is Performance Trust Capital Partners here in Chicago, an institution that I've been getting to know better. That's a big role in the banking world here in the Midwest. We have the CEO, Chirag Shah, joining us from Performance Trust, PT as it's known here. Chirag, it's great to have you.
Very great being here. Appreciate the invite out.
Bringing the attention to kind of underappreciated gems. I mean that in the best way possible, because I want to give some numbers for context for what you guys do. You're a bank, you're trading and execution. You did $100 billion in securities trading annually on an average basis the last 5 years. From an M&A side, you guys did 170 advisory deals since 2013, and your origin is kind of a bank to the banks. So as you've grown, how do you describe Performance Trust to people when you say the 60-second kind of elevator pitch, this is who we are today?
Sure. I'd say at our ethos, we do something very simple. We help community financial institutions make better decisions, right? So the world has gotten a lot more complicated on the financial space with more products, AI, other things that are happening rapidly. And what we are in many ways are guides, but through an analytical framework that on average we see institutions that work with us, they outperform the tune of about 100 to 150 basis points of ROE over time. And the reality is that there's asymmetric trades that are available, asymmetric capital allocation possibilities that are available there. And sometimes you just need more simple, elegant frameworks in order to better identify them.
Okay.
Just one thing, just a little bit of a correction.
Yeah.
Given that we work with about 1,200 community financial institutions, a lot of times people confuse us for being a bank ourselves.
Sure.
So we're actually not a bank, but we work with about 1,200 community financial institutions. On top of it, probably about 1,000, hedge funds, money managers, non-bank originators alike to really help them access capital markets, help them access securitizations across a broad spec of the financial landscape.
You do a lot of work with balance sheets on behalf of those financial institutions. And tell me about when you say kind of the community banks or the regional banks, how should we think about that profile of client that you're mostly working with? What does it look like?
Yeah, so if you think about it, if you go to Canada, for example, in Canada, they have 5 big banks. In the U.S., do you have an idea how many banks and credit unions exist? What's your guess?
Thousands.
Thousands. Almost 9,000.
Okay, I was going to say 10.
Okay, 10. You'd be right there. And the reality is, the big banks, JP, B of A, they do a lot of the business that's there. But if you talk about small business lending, over 50% of the small business loans are being done by these community financial institutions. There's probably about 8,500 of them that are really driving the heartbeat of our community. And we partner with that long tail to build out ubiquitous decision-making frameworks that we partner with them on to try to help them figure out how do we make better capital allocations across their whole balance sheet.
Okay. And so where is that line then between the definition of a bank or an advisor or a separate entity? Because it seems like a lot of things that you're doing, you're going to be competing with traditional banks.
Yeah, I'll tell you what, all lines are blurred. So I take a look at somebody like Apollo.
Okay.
Apollo, you wouldn't think of as a bank at all.
Okay.
But the reality is, last year in 2024, they originated $225 billion in loans. Right? They're stepping into this big void of private credit and are starting to dominate. And they actually made more money from net interest margins, from earning like spread versus collecting fees on assets under management, right? So in a way, they're working to displace banks. Now, what we do on our side, we don't actually do lending.
Okay.
What we do is we actually identify pockets of capital of people who need cash, like a non-bank originator to run their businesses, right? Or people who might need lending. And we identify different people who have money that can invest into them, right? It could be retail. It could be, in most cases, it could be banks. It could be hedge funds or others. And we help actually put together win-win solutions on both sides.
Okay.
So what they don't have to worry about is us stepping in front of them. But that's why we have such trusted partners in the tunes of about like 3,000 people, that institutions that we work with on a day in, day out basis to do a lot of the work that we do.
I've seen you guys' trading floor. It's
Yeah.
very impressive.
Yep.
There's about as many Bloomberg terminals as I've seen since I was at Bloomberg.
Yep.
And that's where I kind of describe you guys as sort of a hidden gem in a way. You
Yep.
have a trading floor that is finding what you guys describe as those asymmetries and a style of trading that you guys liken to Moneyball.
Mhm.
And so much so that you guys' event had Billy Bean speaking at the event. You
Yeah.
guys have bankers that come from all over
Yeah.
to hear about what you're doing. You're also big on education with Performance Trust University. Tell me more about that label and that style of what you guys call Moneyball. How did you get to that? And what did Billy Bean see where he said, okay, actually, yeah, this is similar to what I'm doing?
Yeah, it was very validating. You know, Billy Bean gets asked to come to a lot of places,
Uh-huh.
and so it was great when he was like, "Hey, I'm looking forward to coming out," because one of the things he started to see, in the same way he identified asymmetric risk rewards and took action, he started to see that's what we're doing with banks. And he was talking to our founder. He goes, "You know what? We've been around for 30 years." He goes, "Huh? You guys are essentially doing Moneyball for banking."
Okay.
And when you take a look at Billy, he did something pretty simple. You know, he took a look at this industry. It had this embedded culture of making decisions, of using flawed tools. And all he did was exploit this industry by using publicly available information.
Mhm.
He didn't have secret data, anything like that. He took publicly available information, put it together, and took a look at it through a new lens to take action. So in a very similar way, you know, as opposed to using traditional statistics in finance, such as yield and duration, we take a look at different things, such as total returns, different scenarios, different time periods, count all the cash flows. And we built it through a systematic way that we can repeat and actually help institutions make better financial decisions. And so I think for us, when Billy came in, and you know, for him, in a big way, he talks to a lot of people. But for him, when he got to see that he's talking to the community leaders that are doing the lending, that are driving the small business lending, he's like, hey, this is ethos aligned, both from a impact point of view in terms of, yeah, we're actually doing something differentiated that's leading to better returns.
Mhm.
And it's actually really helping the community at the same time. So it was
Yes.
wonderful to have him come out and join us.
Some of the things that you're talking about in terms of finding those opportunities and then stacking them to create a scale over time through
Yeah.
those asymmetries. I always kind of have this bias because I'm a poker player, and we had a guest on yesterday. We were talking about similarities with poker trading, and we had Pedro Bacasova from Whole Tactical.
Yeah.
Blair Hull is a blackjack player,
Yeah.
and a term that we use at the table a lot of time is leaks.
Yeah.
Right? You want to plug leaks, you want to find your opponent's leak. Now, when you're talking with clients and you're looking at these community institutions and these banks, what are their common leaks? What
Yeah.
are those leaks where you can say, okay, here's our expertise in the world of bonds or whatever it is that we're finding? Is there a commonality in what those leaks are that you guys specialize in plugging?
Yeah. So in Chicago, what's going to happen here in 3 months? What's going to happen in Chicago?
Well, we were talking about having a major political. I've got my mindset on an event that's going to take shape next year, which is the new governor race, obviously.
So that could or could not happen. We don't know.
Uh-huh.
But I'll tell you what's definitely going to happen in 3 months. It's going to be freezing cold.
Okay,
Winter is coming,
cold.
right?
Uh-huh.
So you know that with certainty.
Okay.
But what's amazing, the certainty that we know with weather.
3 months, that might be a little sooner, by the way.
Yeah, that's a good point. But it gets cold here. But what I'll say is a lot of times, if you take a look at assets right now, it's being priced in with a certain amount of rates down cuts that are going to happen. And people look at that. A lot of the banks that we look at that and they say that's gospel. It's going to happen. They're pricing assets to perfection like that's going to take place.
Okay.
Now, if you take a look back at banks, if you take a look at their total returns for the last 7 years for regional banks, they've barely covered their cost of capital, right?
seen
It's
the
been
math on this.
poor. It's been poor performance overall. And a lot of it has to do with the rate bias of what's going to take place. So a lot of times what people will do is guide their institutions based on what they think is going to happen with the economy and not take a look at a series of outcomes that could happen
Right.
and actually identify, well, what are my risk factors, right? Because during this last 7 years, there's been no credit cycle. There's not been a credit cycle since 2008, right? So you think about not covering your cost of capitals, and there has not been a credit cycle, But what happens if rates don't go down
Sure.
by 100 basis points? What happens if a credit cycle comes up? Are you prepared of actually putting around moats to protect yourself? So I think that's one of the big things is how do you create durable returns over time? And that's what a lot of times people miss, and that's very important to align ourselves with. When
Are they
working with
thinking
institutions.
too kind of like binary when there's a spectrum of outcomes and you can find margin and profits on even kind of the tails of those outcomes?
That's exactly it. There's this ability to actually spot asymmetric risk rewards a lot of times at those tail scenarios
Right.
where you have a lot of mispriced options that are taking place. So I think that's the key is just understanding the broader landscape, the broader outcomes that can happen with rates, with optionality, with credit, and putting in the spectrum in a way that you can see both the high amount of risks that are there by taking certain decisions and really work to de-risking many times the tail scenario so you have much more durable return.
Okay.
And not just get so caught up in trying to predict exactly where interest rates are going to go or where the credit cycle is going to go.
Well, I can definitely attest to your guys' and your team based on talking to people from PT that the way they think about bonds certainly is on a different level of sophistication. I say that as someone who fancies themselves a pretty good bond person.
Yeah.
I started my career writing about bonds. My last job, we brought sports producers over and we taught them about bonds as kind of the integral thing. When I talk to your people about the way they think about bonds, they think about it with like 100 sectors of bonds and the different classifications and slicing it in ways that I never thought about before. But tell me as the last point here is, where's the puck going for PT? Where do you take this expertise and the communities that you've built up to this point? Where does that puck go next and what interests you the most?
Yeah, so part of it is it's just not always on the 1 and 3 year horizon. A lot of times people are focused on what are going to happen with the cash flows, with the bonds, with capital raising, whatever it may be. But the reality is the world is changing rapidly over the next 5 to 7 years. And there's big decisions that they're making today in technology or regulation or other aspects that could really disrupt their business today, right? So I just think about fintechs. Fintechs used to be an overused, played out word that people talk about a lot. And people didn't really take it seriously until you look over across the pond at London, for example, in UK. The 4 biggest banks have lost close to 25% of their market share in the last decade, and not to other banks, but to neobanks, right? To new fintechs that are popping up. And a lot of the reason there's been this moat in the US is that there's been a lot of regulation that's been protecting banks from that. But you see what's happening with the new administration, how things are changing. And
Talk
there's
to Bart Smith about stable coins.
Stable
someone
coin
from
and
your guys'
yeah,
team.
stable coin and other aspects that are starting to come through. And so you need to have your day-to-day blocking of tackling of your capital allocation locked down, right? Accessing the capital market when it's open. Right now it's open. Taking out that insurance so you have optionality in the future. Understanding what to do, but at the same time, need to be prepared for where the puck is going. And it's just getting a lot more complex.
Yeah.
And so that's very important, not just to get caught up in the numbers, the dollars, the cash flows of what's happening, but understanding the bigger strategy of what's changing and what place are you going to play within it.
Yeah, very cool stuff.
Yeah.
We're going to come along for the journey. Hopefully keep us posted and we'll be in touch, Chirag. Thanks a lot.
All right. Very good to be out here. Good seeing you.
Absolutely fascinating conversation. We're going to go from bonds into options. Chirag Shah, the CEO of Performance Trust. When we come back, we're going to talk to a $400 million RIA. We talked to some big ones at the top of our show, some of the biggest giants in the Midwest. We're going to learn how the smaller advisors grow fast, and hint, they're doing it using options. Be right back. Welcome back to Chicago Future of Finance. We are hitting the spectrum of asset classes and business models in finance. Joining me, Seth Hickel is co-founder at Mindset Wealth Management, a roughly $400 million advisor in town from Indianapolis. Seth, thanks for being here.
Yeah, it's great to be here.
This is a great conversation because so far we've talked to some of the giant RIAs in the Midwest, but the balance here is that we also want to know how someone less than $1 billion gets there and grows.
Sure.
And I know a lot of what you guys do is option-centric. Your background is option-centric, so you fit right into what we're doing. Tell us about Mindset.
Yeah, Mindset Wealth Management is a firm created by three of my business partners and I. We broke out of another RIA. We had some clients come with us, and a lot of those clients were already trying to trade in some options. So they really wanted that consistent management as we kind of moved and transitioned into the new story of our lives.
Okay. You guys use options for what, like 70% of your clients? That feels like a pretty high number for your average advisor.
So we're a little bit different than most advisors. We really pride ourselves in helping clients manage their portfolios by using options as a key component of that portfolio management. So we like to think of ourselves as stock pickers and not really asset allocators. So we have a very active role in the management of our client positions. A lot of our clients have brought to us highly appreciated positions, highly concentrated positions.
And
a lot
theme right now. Theme.
A lot of advisors really have a hard time unlocking value in those portfolios. Oftentimes it's a neglected piece of the client's portfolio. And what we've really been able to do is come in and unlock some value, not only for, the advisor side of it, because we can bring those assets in-house, help the client manage them, but also for the client side of it, because this is a stagnant asset. And a good example might be a stock that is paying 1%, 2% dividend. And if we can use an options overlay strategy to enhance the yield, either through, say, covered calls, naked puts, or put spreads, and we can capture an additional 3 to 4% a year, you can really enhance the value of this stagnant position
without having to sell it.
Without having to sell it,
without having to take a tax hit.
Yeah, we have clients that have very, very low cost basis on some positions, and if they sold it, the tax man would come, and they don't want to realize the tax maybe in all of this year. So we can then slowly kind of unwind that position, use some of that premium even to pay for some of those taxes.
Okay.
Or if they just want, they can use it as distributions for income.
How do you make sure if you're starting with the place that is a big position and you're going to use options to try and create income around that, how do you make sure that you don't pay too much for the options using the trades you're doing? Because if I think of it myself where I've got a options trade specific on, I want to try and do it at the absolute best margin I can get, right? The best fill I can get. But if I have this massive, NVIDIA position or something, then I might be willing to take a little bit more slippage.
Sure. So what we do is I've created an institutional grade framework to use in the management of these portfolios. So we can apply our strategies for in accounts that are $10 million or accounts that are $500,000. Okay. So we've created some guardrails and risk management process basically in order to properly scale the risk in each portfolio. Another thing that we do is ladder the expirations of the positions. So at any given point, we might have some exposure coming off where we're constantly then upping exposure as exposure comes off. Okay. So you can kind of ride the ebbs and the flows of the market and make sure that position sizing and exposure is consistent.
Okay. What is the common kind of position? Is it tech heavy generally?
Yeah, a lot of our clients do have highly appreciated tech heavy positions. Yeah, but at the same time, those positions, since they have really moved up in value, the clients just don't know what to do with them. They bought them 10, 15 years ago, and they're looking for guidance on how they can, again, unlock some value in those portfolios.
What is the conversation that you find yourself having with potential clients, and let's say you're trying to poach somebody from another advisor? Is it that they know that options have these tools and their advisor doesn't know how to use it, or are people just still generally I mean, I think from what I'm seeing and what we see with the products that are people, obviously the education and knowledge about options is getting there. Are people seeking that out at this point?
Yeah. So I think the biggest challenge to most advisors as well as individual investors is changing their mindset on what an option can do for a portfolio. They hear about how risky options are. They have seen the stories where firms have blown up, and they have this perception in their head that options are this big, scary strategy. And, I've gone to a lot of conferences and talked to a lot of advisors. You start talking about options, they look at you with this blank stare that kind of tells you everything you really need to know.
Yeah.
They might have dabbled in some covered calls in their own portfolio, but they just don't have the education or the background or really the mindset that allows them to really get into that market. They might not have the capacity either. If they're a salesman, if their primary goal is relationship management, then that might not be the best tool in their toolbox, where they can then maybe farm that out to somebody else. We're looking at standing up an asset management arm where we can actually introduce some of these strategies and products to other advisors, because when that conversation stops at covered calls, they still might have a client out there that has a concentrated position. And sometimes you talk to some advisors that really want to learn more, but they don't have the tools in their toolbox to really excel at it.
How much is the opportunity for these trades and for this style of management market dependent? And is there a line at which you say, okay, we've achieved our goal for this period of time? Or do you say, hey, the market's juicy enough where let's push this?
Yeah, we try to stay consistent. So we always have positions on. Even if the market is falling, I will sell into those positions. Spikes in volatility create opportunities. So if you look at forward returns, when the VIX is at above 30, 35, 40, 45, forward returns are amazing. So those are the times when volatility starts to increase and people are then pulling back. We are leaning into it, and we want clients that also have that same mindset as us, where markets start to get a little wish-washy, and they're looking for that opportunity and not running away from it.
Okay. Any thoughts on how the market looks right now? Anything that you've been busy with this week or today?
I think the market is a little bit lofty right now. The PE is just too high, right? So what we try to do is keep duration short in this period, and be a little bit more nimble, have the ability to scale out of positions in a shorter amount of time in case things get a little more rocky than where they are today. Got a big jobs number tomorrow.
Yeah, it's a big number. Seth, really interesting stuff. Great perspective and a nice angle for us to figure out how to use options to grow and compete as a growing advisor. Great stuff. Thanks for coming down to Chicago.
Absolutely. Thank you.
I know you used to be here.
Yeah.
So thanks for coming back.
Absolutely. It's great to be home.
Like that. Seth Hickel, Mindset Wealth Management. Let's talk market. Let's talk tomorrow. Let's go to the risk radar. Scott Bauer is standing by. Everything on the risk radar stands where it was yesterday. Stocks green. See the bull down there looking pretty green. We got highs. We're up right now almost 80 bips. Gold gave back a little bit here today, but just marginal 80 bips after a huge rip. So gold still is green on the radar too. Watch for bonds and the dollar and coins for tomorrow, because it looks like the coins are just heavy regardless. Another down day for BTC, but the dollar and bonds still don't have a clue. So yellow there, trying to figure out some range. Dollar creeping up again. Mr. Scott Bauer, CEO of Prosper Trading Academy, with us for some thoughts here on the closing bell. Pretty good session here, Scott.
Earlier this morning, it looked like things were turning south. We got back to pretty much even on the S&Ps, and then as the day progressed here, I'm not really sure what is the impetus behind this, because the data that came out this morning was pretty mixed. The jobs numbers weren't good either from ADP. The weekly jobless claims, those weren't good. We got manufacturing services data, which was kind of mixed. Import, export, trade data, which was way out of line. And then here we are, though. And what we're seeing, Oliver, is the CME FedWatch tool is up to a 98% probability of a cut in September now.
Right. So no matter what happens tomorrow.
Exactly. So the market is almost prepping for a number that is in line, maybe it's a tad strong, which is fine, but a number that really is not going to derail what the current path is for the Fed. But it's really interesting because I don't know what happened during the day today to see that shift. And when I take a deeper dive into option markets in SPY and the Qs, IWM, there is a pretty large skew to the downside. So if we look at, 3%, 5% out of the money options, the skew on the puts is way higher than it is on the calls. And
The
yet,
calls are still cheap,
yep. And yet here
even though
we
we keep
are,
grinding.
here we are, with pretty green on the screen heading into tomorrow morning.
Yeah, that's a good point and a good follow-up from yesterday, because it just looks like folks aren't ready to buy in for whatever reason, which is kind of strange. When the market seems to be, I think NVIDIA maybe scared people a little bit because it came off post earnings. I think maybe the crypto stuff that's been looking kind of weak maybe also, but all that stuff is kind of secondary.
Yeah, I think it is the crypto stuff, but you're right, it is secondary. But listen, there's a lot of money. There's a lot of money in the crypto space, and we're not just talking in actual crypto, but the funds that own them. So all of the ETFs, on the equity side of things, there's a lot of money. And then obviously, MSTR, which is, kind of used as a proxy for Bitcoin. I know you were talking about that a little earlier. To me, it's surprising that MSTR is not actually ticking up today, even with Bitcoin being a little bit weaker, because there's all this chatter that MSTR is going to be included in the rebalancing for the S&P.
Yeah.
We might find that out tomorrow. If that happens, I would expect MSTR to go higher. But you're right. Bitcoin, Ether can't hold a bid right now. And if you look at Bitcoin specifically, that 110 area, that's a pretty significant area. And we dipped down below there earlier this morning, just as for the bulls, it couldn't break out on the upside at 112.5, 113. 110 is a pretty significant line in the sand on the downside.
I'm looking at IBIT right now, down 2% on the day. Master found a little bit of life here. And by the way, stocks too, into the bell, finding more buyers. Just a nice rip there in the last 15 minutes. You mentioned,
we saw that yesterday too.
Yeah, same story, right? Same time. By the way, IWM at 237 right now, up more than 1%. So the small caps are really waking up.
Yeah. Which listen, that, you look at the small caps as maybe a reflection of what the landscape is for interest rates, right? And so, maybe people are looking at tomorrow's number as being in line or maybe a bit weaker rather than on the bounce back side.
Yeah. The small cap potential for some leadership, some rotation. I think a lot of folks were looking for that. So that's there. Gold, GLD came off a little bit, but I don't think anything we talked about yesterday changes really. SLV, though, it just seems to always be the weaker version of the two, which is kind of frustrating.
It is really frustrating because just as for the, as a comparison to crypto, for the longest time, we were looking for ETH to, catch up to Bitcoin a little bit, in that ratio. Same thing with the gold silver ratio. We've been, really waiting for that ratio to narrow down a little bit, for silver to maybe outperform a little bit, and really just hasn't happened.
Yeah. The master trade that I was in, I'm largely out of that, partly because I'm going to Vegas and it doesn't hurt to have a little extra liquidity, but also because I feel it was just a pretty darn good trade, basically from late June and July down. To your point about the cryptos having a bunch of assets behind it, the other way to look at that theme that your guy Charles Moon brought up to me was some of the miners that were pretty good, but I don't know, maybe those are starting to break down a little bit. It just, I don't know, the market for some reason, I guess, is just prioritizing the rotation into other stocks rather than crypto stuff right now to some extent.
Yeah, the trade could also be getting a little long in the tooth. It could be a little bit of a tired trade here.
Yeah.
And I think that, specifically with Bitcoin and Ether, not so much some of the other alts, but specifically with those two, you might see some, risk taking off ahead of tomorrow. So depending what that news is tomorrow, and depending on what the trajectory of other rate cuts are, not September, but beyond October, December, even going into, Q1 of 2026, we could see a little bit of a pop in the crypto space.
Talking bonds and tomorrow, TLT 70 bips up today, pretty decent rally. I'm going to zoom out a little bit here to give the year-long perspective because I can't find much of a trend in bonds yet, but I wonder, Scott, if tomorrow locks in a cut, if maybe TLT does start to break out higher in price, lower in yield for bonds.
So it is set up for that. And here's why I say that, because recently we have seen, the short end of the curve really move a lot differently from the long end. The short end of the curve has been stable, maybe even coming down a little bit, while the long end has been going higher because of the risk that is associated with global bonds, global bond markets, central banks, just borrowing and borrowing and borrowing. So if we start to see that Fed funds rate in the future come down a little bit, then that could stabilize some of the longer end, which TLT is representative of the 20-year. So when you look at that or the 30-year bond, we could see some stability there, see some bids come in and yields come down a bit.
All right, like that. Any trades that you like for tomorrow, whether macro or stocks, Scott? And we talked yesterday about the strangle spreads or swaps rather that you were looking at for the kind of the broader market, but some particular names you mentioned as well.
Yeah, there were, and one of them actually has earnings out after the close tonight. DocuSign that I have that exact position on. Yeah. So that'll be for tomorrow. But going into the rest of the day, unless there's a big outlier tomorrow, I think we're still going to have summer trade tomorrow, just like last Friday going into the long weekend. So I think we could see that tomorrow unless there's a big outlier number. So I know I'm really light on my positions. Heading into a print like this, I don't need to pick a side. So unless there's something that I really have strong conviction behind, I'm on the sidelines, which is fine.
Yeah, fair enough. That's kind of my thought too. Part of the reason I took the master trade off. VIX 15.8 for the day. Thanks, Scott. Appreciate it, Mr. Bauer. Good closing bell comments.
Thank you, sir.
Yes, sir. CEO, Prosper Trading Academy. All right, that's it. Thanks for tuning in today. I will see you from Vegas next week. Don't miss our coverage from the Hood Summit in Las Vegas, Tuesday and Wednesday next week. It's going to be fun. We got a nice lineup. We're going to have a SIBO special show with some of the minds from this institution out in Vegas. A little different mindset. And tune in to me on the socials. I might do a little poker content. We'll see. Have a great night.